You just cost yourself $1.8 million trying to chase a return. VOO does a great job in low cost matching the market. We get a lot of questions about what ETFs to buy. We can never tell you what ETF to buy. However, in my position, if I were buying ETFs, and by the way, I used to be 100% ETFs 15, 20 years ago. As time went on, I started to switch from all ETFs to smaller portions until now I only buy individual stocks because I've learned the process. But if you're interested in buying ETFs for the majority of your money and having a portion of it go to individual stocks, I love it.
Yeah, it's a great place to be, to dollar cost average every month, every quarter, every year, whatever you want to do. And I mean, look at the long-term chart. This is what you do. You notice there's some big dips in here, there's big dips in here, there's big bumps, but along the way, look where this thing has gone.
It's going to follow the S&P 500.
Exactly.
That's what it's going to do. And it's going to do it super cheap. Guys, you got to remember, and some of you might be new to this and hearing this for the first time, those guys who actively manage mutual funds do worse than the market. Not only do they not match the market in terms of performance, then they charge you upwards of 1 or 2% a year to manage the money. And that's taken extra on top of that.
Here's what you're being charged.
At VOO, you're being charged 0.03% versus 1%. Exactly. What's the difference there? At $10,000 invested, the mutual fund's going to charge you $100 per year. VOO is charging you $3 per year. And they're matching the market. Then the 1% people, isn't that interesting? Yeah. The active managers who charge 1% aren't even beating the market, and then you're getting 1% less every single year.
Yeah. And you might say, oh, it's only $97 a year. Over a long period of time, that adds up very quickly.
So in our software, we have this retirement calculator. And this one's great because it doesn't only show you how much money you'll have at retirement, but also what's your goal for living the rest of your life. Do you have enough money to live to the rest of your life? Now, I want to show you the difference of that 1% versus 0.03, but I want you to hear a couple of things first. One, it's something like less than 5%. I don't know the exact number of actively managed mutual funds beat the market over a 10-year period. On any given year, it's only 18% beat the market. But as time goes on, it's harder and harder. So you're automatically losing by investing in actively managed mutual funds. And the ones that do beat the market, people get in too late. Peter Lynch got 28% returns on his fund, and he said his average investor didn't even make anywhere close to that. Probably didn't even beat the market because they started investing when his track record was already really great and the market was already really high.
And when the track record's up here, you're going to be probably paying a higher expense ratio to them because
like
they're
ARK.
Really good.
Look at ARK Investments.
Yep.
ARK Investments, even when it was only down 50%, the majority of their investors were in the negative because the majority of investors invested after a big run-up. Imagine a world in which life is easier and you made more money. Let's show you here. So our retirement calculator, let's say you're age 30 and you want to retire at 65 and your current savings are $30,000 and you're going to save $12,000 a year. And you're going to increase that by 4% a year. Now, if you match the market with a Vanguard long-term ETF, over 35 years, you should get between 9 and 10% a year. Let's just say it's 9%.
Okay. And
let's say during retirement, let's just avoid retirement talk right now. Let's say you live to 100, and during retirement, you make 5% a year. And inflation is 3.5%, and your current income is $60,000, and you want to make 100% of your money. Okay. So first off, you don't have enough to retire. You need to save $1,200 more per year. That's what's great about our software. Not only does it tell you yes or no, if it says no, it tells you exactly how much more you need to make per year. But at retirement, based on this, you'll have $5 million. Not bad.
Sounds good.
Right? So the market makes 9%. You make, actually, you know what? 8.97 because that's what the fees are. You're going to have $5 million.
Sounds really good.
Great. Now, let's say you're an actively managed mutual fund. You're in that. And the market, they already trail the market by 1% per year. So your 9 becomes 8. Yep. And then they charge you fees of 1%. 8 becomes 7. How much does it cost you? Well, you used to have to save $1,200 a year more. Now you have to save $9,000 a year more. And at the age of 65, you have $3.2 million versus $5 million.
Wow.
You just cost yourself $1.8 million trying to chase a return. VOO does a great job in low cost matching the market. Now, I also believe that the issue with ETFs is so many people are in them that when the selling starts, because we haven't seen indiscriminate selling yet.
No, not yet.
We have still seen inflows in these ETFs in the last year, even though the market was down 15% or whatever it was down last year. Once that happens, it will drive stock prices lower. But remember, don't get scared. That's why you need to watch this channel. That's why you need to subscribe. We will show you not to be scared. This is the long-term value of the stock market. But this is how stocks go. And if you've watched any of our videos, I've done this 1,000 times. Your job is to dollar cost average along the way. Sometimes you'll overpay, sometimes you'll underpay. But over time, you will match the market.
Yep.
And if you have the balls to do this, invest more when it's below value.
Yeah.
And every day in our stock market community, in our community chat, I created my own S&P stock market to GDP ratio going back to 1929, when I show what that ratio says we are in terms of overvalue and undervalue. And there are issues with that ratio. I even disagree with the ratio on some aspects. Mm-hmm. So it shouldn't be taken as a grain of with absolute finite, this is right. But the point is, if you invest, take the thinking out of it. Because even if the market only does 5% a year for the next 35 years, you're probably still going to beat an actively managed mutual fund. Yeah. Right, Mo?
Yeah, absolutely.
And when I first started doing value investing, I was literally 100% ETFs, like VOO and SPY. Over time, I went to 80-20, then 70-30, then 50-50. And from 50-50, I jumped to 0 ETFs to 100. So the other reason to follow our channel is we talk about individual stocks all the time. Mm-hmm. But you've got to learn a process before you do that. But the most important thing is the psychological, mental aspects of how you view investing, right?
Yeah. And investing in those it's very hard to want to be a big buyer right here. And
it's very difficult.
I would make the argument that a lot of people in our community, they find it equally as hard to be buying up here, because they look at I'm going to try to draw this line. They look at this as saying, oh my God, that is so overbought as much as it's oversold. But the point is, sometimes you're going to be a bug, sometimes you're going to be the windshield. It's going to balance out over a long period of time.
As long as you're consistent.
As long as you're consistent. Exactly.
That's the hardest part.
Don't try to time this thing. Don't try to time this line. It's not going to work.
And I have the ability to not be in stocks for long periods of time, but I have a different situation than you. I have many businesses generating me cash flow. I make money off options. I'm okay with that. I don't need, but when you're waiting for retirement, if you miss out on 5 or 6 years, that can directly affect your retirement goals. So just every single month, every single year, whatever you're doing, figure out the ETF you want to do, and that'll be the best way to get long-term results. However, if you want to learn buying individual stocks, that is awesome, and I encourage you to do it, but don't buy individual stocks without understanding a process. And I want you to do me another favor. Go watch 4 or 5 of our videos about individual stocks. We have our 8-pillar analysis. We look at them individually, and we look at the company separate from the stock. And it can be boring at times because now we're not buying a lot of companies, but eventually get to the point when we're buying a ton of companies. You know what the market's going to say? Stocks suck. Yep. But we're going to be the guy saying, no, stocks are a good buy right now. It might take years and years, just like it took years and years of this bubble to collapse. And we don't think we're anywhere close to a down market yet. Everybody's talking about a 20 or 30% in the high side drop from here. We disagree. We're not trying to be fudsters, trying to be fear, uncertainty, and doubt. We're just saying based on long-term valuations, and more importantly, where people's euphoria has gone. When every average kid in high school is a crypto expert or buying Tesla or things like that, that worries us.
Big time.
Big time. So guys, if you like this retirement calculator, there's a ton of other software that comes with it. We have a special on everythingmoney.com, $7 for 7 days. Try it out. Don't forget to subscribe to the channel. Thank you very much for your time.